December 25th, 2025, Christmas morning. While most of the world is opening presents, something extraordinary just happened in China's financial markets. Something that should make every silver investor sit up and pay attention. China's only pure play silver fund, the UBS SDIC Silver Futures Fund, just crashed by its maximum daily limit. 10% down in a single day. Circuit breakers triggered, trading halted. And this isn't just another market correction. This is the ending to a speculative frenzy that fund managers had been warning about for weeks. 5 separate warnings in December alone. All of them were ignored. Until today, Let me show you exactly what happened, why this matters far beyond China's borders, and what this tells us about where silver is heading in 2026. Because this story isn't about one fund crashing. It's about what happens when speculation collides with reality at the worst possible time. Silver just hit $72.70 per ounce on Wednesday, an all-time record, up nearly 150% year-to-date. That's not a typo. 149%, the best annual performance since 1979. And while everyone was celebrating record highs, the smart money was screaming warnings that nobody wanted to hear. The UBS SDIC Silver Futures Fund, LOF, is China's only pure-play silver investment vehicle for domestic retail investors. Think of it as China's version of the SLV ETF, except it's the only game in town. If you're a Chinese retail investor who wants exposure to silver without buying physical bars or trading futures, contracts yourself, this fund is basically your only option. And that created a problem, a massive problem, because when silver started rallying in 2025, Chinese investors piled into this fund like there was no tomorrow. The fund wasn't just tracking silver prices, it was trading at a premium, a big premium. By early December, the fund was trading 12% above the value of its underlying assets. Now let me explain why that's insane. When an ETF or fund trades at a 12% premium to its net asset value, it means investors are so desperate to get in that they're willing to pay $112 for every $100 worth of actual silver exposure. That's not investing anymore. That's speculation. That's fear of missing out. That's the sound of a bubble inflating. UBS SDIC Fund Management, the company running this fund, saw what was happening. And they did something almost unheard of. They issued public warnings. Not one warning. 5 warnings in December alone. The language was blunt, direct, urgent. Here's what they said. Investors who blindly invest in fund units with high premiums may face significant losses. Think about that for a second. The fund manager is literally telling potential investors, don't buy our fund, you're going to lose money. That's like a casino putting up a sign saying the house always wins, go home. When was the last time you saw a fund manager actively trying to scare away customers? It doesn't happen, unless they're genuinely terrified of what's coming. But Chinese retail investors didn't listen. They kept buying. The premium kept expanding. The fund kept rising. And silver kept hitting new records. Until Wednesday, December 24th, when silver touched $72.70 per ounce, the highest price in history. And then everything changed. Thursday morning, December 25th, Christmas Day, the UBS SDIC Silver Futures Fund opened down 10%, the maximum daily limit allowed by Chinese market regulations. In China's stock markets, there are price limits that prevent securities from moving more than a certain percentage in a single day. For most stocks and funds, that limit is 10%. Hit that limit, and trading gets halted for the rest of the day. The fund hit the limit instantly, down 10% at the open, trading halted. And here's the terrifying part for investors who were still holding. That 10% drop doesn't include the premium collapse. Remember, the fund was trading 12% above its actual value. When sentiment shifts and everyone tries to sell at once, that premium doesn't gradually decline. It evaporates instantly. So investors aren't just taking a 10% hit from the daily limit. They're taking another 10% to 12% hit as the premium collapses back to reality. That's a 20% to 22% loss in a single day on Christmas morning for a fund that tracks silver, which itself only dropped about 2% to 3% from its peak. This is what happens when speculation becomes untethered from fundamentals. The fund wasn't trading on silver's value anymore. It was trading on momentum, on FOMO, on the belief that someone else would pay even more tomorrow. And when that belief breaks, the collapse is brutal and immediate. Let me walk you through the timeline of how we got here. Because this didn't happen overnight. This was a slow-motion train wreck that everyone could see coming except the people buying at the top. October 2025, silver breaks through 50 per ounce for the first time since 2011. The move is driven by legitimate fundamentals. Global supply deficit in its 5th consecutive year. Industrial demand from solar panels, electric vehicles, 5G infrastructure, all surging. Mine production is stagnant. The setup is bullish, no question. November 2025, silver accelerates. $54, then $56, then $58. The rally is picking up speed. And this is where Chinese retail investors start paying attention. Remember, China is the world's largest consumer of silver, but for most of China's history, silver has been viewed as an industrial commodity, not an investment asset. That's changing rapidly. Why? Because Chinese investors are looking for alternatives. The Chinese property market is still in crisis. Stock markets are volatile. Capital controls make it hard to move money overseas. And inflation is eating away at savings. Sound familiar? It should. Because those are exactly the conditions that drive investors toward hard assets, toward things that can't be printed or manipulated by central banks. Early December 2025, silver crosses $60. This is a major psychological level. And Chinese investors are now flooding into the UBS SDIC fund. Trading volumes on the Shanghai Futures Exchange for silver contracts spike to levels not seen since the October squeeze. The fund's premium to net asset value starts expanding. First 5%, then 8%, then 10%. December 11th, 2025. UBS SDIC issues its first warning. The fund is trading at a 12% premium. This is unsustainable. The warning is published on their website, filed with regulators, and reported in Chinese financial media. The message is clear. If you're buying this fund at a 12% premium, you're setting yourself up for losses. The market's response? It ignored the warning completely. The premium stayed elevated. Buying continued. And silver kept climbing. 62, 64, 68. New records every few days. December 2025 continues. UBS SDIC issues a second warning, then a third, then a fourth, then a fifth. 5 warnings in less than 3 weeks. Each one is more urgent than the last. And still, investors kept buying. Because silver was going up. Because everyone they knew was making money. Because this time felt different. This is the psychology of bubbles. Not the bubble in silver itself, but the bubble in the premium. The actual metal was experiencing a real supply-demand squeeze. Industrial demand is legitimate. The deficit is real. But the fund's premium? That was pure speculation. That was people buying because the price was going up, and price was going up because people were buying. A circular logic that always ends the same way. December 23rd and 24th, silver hits its peak. $72.70 per ounce on Wednesday the 24th, an all-time record. The media is full of stories about silver's incredible rally. Analysts are debating whether it can hit $75, $80, even $100. The excitement is palpable. The momentum feels unstoppable. And then Thursday morning arrives, Christmas Day in the West, a regular trading day in China. The UBS SDIC fund opens, and it immediately crashes 10%. Daily limit hit, trading halted. The frenzy is over. Now, let's talk about why this matters. Because if you're thinking, this is just China, this doesn't affect me, you're missing the bigger picture. This crash is a signal, a warning shot. Not just about this one fund, but about what's happening in silver markets globally. First, understand what the premium collapse tells us. When a fund trades at a premium to its net asset value, it means demand for shares exceeds available supply. Investors want in so badly, they'll pay above the actual value of the underlying assets. That's fine when it's a 1% or 2% premium. That's market friction, liquidity mismatch, normal stuff. But 12%, that's not normal. That's excessive speculation. And when that premium collapses, it tells you something critical about market psychology. It tells you that the marginal buyer, the last person willing to pay above fair value, just disappeared. And when the marginal buyer disappears in a momentum-driven market, price follows quickly. Second, this crash reveals the vulnerability of leveraged positions. And we don't know exactly how leveraged Chinese retail investors were in this fund, but we know Chinese markets allow margin trading. We know speculation was rampant. And we know that when leveraged positions start getting liquidated, it creates a cascade effect. Forced selling begets more forced selling. Stop losses trigger, margin calls hit. The decline feeds on itself. Third, and this is the most important point, this crash demonstrates what happens when a market runs on pure momentum rather than fundamental buying. Silver's fundamentals are strong. Supply deficit, industrial demand, monetary hedging, all legitimate. But when price action disconnects from fundamentals, when buying is driven by chart patterns and FOMO rather than supply-demand analysis, corrections become inevitable, and they're always more violent than anyone expects. Let me be very clear about something. This is not me saying silver is done. This is not me calling a top in the silver market. The fundamental case for silver remains intact. The supply deficit is real. Industrial demand is real. The mine supply constraints are real. Central banks are still buying gold aggressively, and silver tends to follow gold with leverage. What I am saying is this. The speculative excess that built up in December, particularly in China, just got flushed out. And that's actually healthy. Markets need corrections. They need to shake out weak hands. They need to reset sentiment. Because sustainable bull markets are built on solid foundations, not on 12% premiums driven by fear of missing out. Now, let's connect this to the broader silver story, because what's happening in silver right now is genuinely historic. And the China fund crash is just one chapter in a much larger narrative. Silver in 2025 delivered a nearly 150% return through December 24th. Let me put that in context. Gold, which everyone thinks had an amazing year, is up about 70%. Silver nearly doubled gold's return. The S&P 500 up maybe 25%. Bonds, barely positive after inflation. Silver crushed everything. Why? Three converging forces. First, the supply deficit. The silver market has been in deficit for 5 consecutive years. 2021, 2022, 2023, 2024, and 2025. The cumulative shortfall is approaching 800 million ounces. That's roughly equivalent to an entire year of global mine production. Just gone. Consumed and not replaced. And here's why this matters more than most people realize. Silver isn't like gold. Gold is mostly hoarded. Central banks buy it, investors buy it, jewelry buyers buy it, and most of it gets recycled or stays in vaults. The gold market is about 90% above ground stock and 10% annual flow. Silver is the opposite. 59% of silver demand comes from industrial fabrication. Solar panels, electronics, 5G networks, medical devices, water purification, batteries, automotive applications. And once silver is used industrially, most of it doesn't get recycled. It's too expensive to extract from products. So it's effectively destroyed, consumed, gone forever. This creates an asymmetry. Every year, industry consumes more silver than miners produce. And that gap has to be filled by above-ground inventories, by vaults, by exchange stocks. And those inventories are shrinking dramatically. COMEX silver inventories have been drawn down significantly over the past 2 years. Registered silver, the portion available for immediate delivery against futures contracts, is at levels that make the market extremely sensitive to even modest demand spikes. And when inventories get this low, price becomes the only mechanism to balance supply and demand. Second force, industrial demand acceleration. The electrification of everything requires silver. Electric vehicles use roughly 25 grams of silver per vehicle. Some estimates suggest that it could rise to 50 grams or even more if solid-state batteries using silver become mainstream. That's 1 kilogram or more per EV. Solar panels are even more dependent on silver. Every solar panel requires silver paste for conductivity. There's no substitute that matches silver's performance at scale, and global solar installations are accelerating. China alone is installing gigawatts of capacity monthly. Each gigawatt requires roughly 30 tons of silver. 5G infrastructure, AI data centers, advanced electronics, all silver intensive. And unlike investment demand, which can disappear when sentiment turns, industrial demand is sticky. Manufacturers need silver regardless of price. They'll pay $30, $50, $70, $100 per ounce because silver represents a tiny fraction of their total cost. A solar panel manufacturer is not going to stop production because silver went from $25 to $70. They're locked in. They need the metal. Third force, monetary demand returning. This is where it gets interesting. For most of the 2010s, silver was ignored by investors. Gold got all the attention. Central banks bought gold. Hedge funds bought gold. Retail bought gold. Silver was seen as too volatile, too industrial, too messy, but that's changing. Why? Because silver is dramatically cheaper than gold. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, recently hit 72 to 1. The long-term historical average is closer to 60 to 1. During periods of monetary stress, that ratio has dropped as low as 15 to 1. If you believe in precious metals but think gold at $4,200 per ounce is too expensive to build a position, silver at $70 is accessible. That's the retail appeal. And retail investors globally, not just in China, are waking up to this dynamic. ETF inflows into silver have been substantial in 2025. Silver ETF holdings have risen to roughly 844 million ounces, up about 18% year over year. That's 130 million ounces of investment demand. And when you combine that with the industrial deficit, you get a market where physical supply is genuinely tight. This brings us back to the China fund crash. Because what just happened in China is a preview of what could happen in other markets if speculation gets out of hand. Not in the silver price itself necessarily, but in the derivative products, the ETFs, the funds, anything that allows leverage or trades at a premium to underlying value. Here's what investors need to watch going forward. First, premium levels on silver ETFs. If you see SLV or PSLV or any silver fund starting to trade at consistent premiums to net asset value, that's a warning sign. A small premium is fine. A large premium means speculation is overtaking fundamentals. Second, open interest in futures markets. When open interest on COMEX silver futures expands rapidly, particularly if it's driven by speculative longs rather than commercial hedging, it creates vulnerability because those positions can unwind quickly, forcing price corrections that have nothing to do with physical supply and demand. Third, retail sentiment indicators. When your Uber driver is talking about buying silver, when mainstream financial media breathlessly covers the rally, when social media is full of silver squeeze talk, you're approaching euphoria. And euphoria is always followed by correction. Always. Fourth, and this is critical, watch the spread between paper and physical prices. During March 2020, when COVID panic hit, silver futures traded at $15 per ounce while physical coins were selling for $30 or more. That disconnect revealed stress in the physical market. If we see that again, if premiums on physical silver explode while paper prices stay moderate, it's a signal that the paper market is breaking down. Now, what does all this mean for silver in 2026? Let me walk through the scenarios because, unlike a lot of commentary out there, I'm not here to sell you on one narrative. I'm here to show you the range of possibilities based on what we know. Bullish scenario. The fundamentals that drove silver to $72 remain in place. The supply deficit continues. Industrial demand keeps growing. Central bank gold buying supports precious metals broadly. The China fund crash is a temporary shakeout that clears speculative excess and sets the stage for the next leg higher. Silver consolidates between $60 and $75 for the first half of 2026, then breaks out to $85, $90, maybe even $100 by year end. This scenario is plausible if industrial demand growth continues, if Western economies experience another round of inflation requiring more monetary easing, and if geopolitical tensions keep safe haven demand elevated. It's the scenario where silver's dual role as industrial metal and monetary asset creates a perfect storm of demand that overwhelms constrained supply. Base case scenario. Silver enters a consolidation phase after the parabolic move in late 2025. The China crash is just the beginning of a broader correction that takes silver back to $55, maybe $50 before stabilizing. This isn't a collapse. It's a healthy digestion period after a massive rally. The fundamental deficit remains, but the market needs time to build energy for the next move. Silver trades in a range between $50 and $65 for most of 2026, with potential for a breakout in late 2026 or 2027. This scenario assumes that industrial demand growth moderates slightly, investment demand takes a breather after huge gains, and there's no major crisis that drives panic buying. It's the muddle-through scenario where silver remains supported but doesn't explode higher. Bearish scenario. The China fund crash is the first domino. Speculative excess built up globally, not just in China. As those positions unwind, silver corrects more sharply. Back to $40, maybe $30. The supply deficit thesis gets questioned. Maybe industrial demand is overstated. Maybe recycling picks up more than expected. Maybe a new mine supply comes online. Or maybe the global economy slows more than expected, reducing industrial consumption. This scenario requires either a demand shock, a supply surge, or a broader risk-off event that takes everything down together. It's the scenario where silver's volatility works against holders, where the nearly 150% gain in 2025 gets partially given back in 2026. Not a permanent top, but a painful correction that shakes out weak hands. Personally, I'm leaning toward a base case with upside potential. The fundamentals are too strong for a sustained collapse. But after nearly 150% move, some consolidation is healthy and expected. The China crash removes some of the froth, and that actually improves the long-term risk reward. Because the worst thing that can happen to a bull market is a blow-off top driven by pure speculation. That creates crashes that take years to recover from. A measured correction here keeps the bull market intact. Let me address the elephant in the room. Is silver manipulated? This is a question that comes up every time we talk about precious metals. And the answer is complicated. Yes, large banks have been fined for spoofing and manipulation in precious metals markets. JP Morgan paid $9 to $20 million in 2020 to settle manipulation charges. That's a fact, not a theory. But here's what that doesn't mean. It doesn't mean that every price move is manipulated. It doesn't mean that fundamentals don't matter. It doesn't mean you can just buy and hold and ignore market dynamics because manipulation will end and we'll moon. That's a fantasy that costs people money. The reality is more nuanced. Large institutions have the ability to move markets in the short term through futures positioning, through high-frequency trading, through option strategies that most retail investors don't understand. But they can't override fundamentals forever. They can't create supply that doesn't exist. They can't eliminate demand that's real. What they can do is create volatility. They can shake out weak hands. They can engineer liquidation cascades that force retail investors to sell at the worst possible time. And then they can step in and buy at lower prices. That's not a conspiracy theory. That's how markets work. Large players with information advantages and capital advantages can exploit retail psychology. So what's the takeaway? If you're buying silver, buy for the right reasons. Buy because you understand the supply deficit. Buy because you see industrial demand growing. Buy because you want exposure to a hard asset that can't be printed. Don't buy because you think there's a manipulation that's about to end and make you rich overnight. That's speculation, not investment. And if you're going to hold silver, hold physical, or hold ETFs that are backed by allocated physical metal, don't leverage yourself through complex derivatives. Don't chase premiums. Don't FOMO into rallies at all-time highs. The China fund investors who bought at a 12% premium despite 5 warnings learned that lesson the hard way. Don't be them. Here's something else worth mentioning. The United States designated silver as a critical mineral in 2025. This might sound boring, but it's actually significant. Critical mineral designation means the government recognizes silver as essential for economic security and national defense. That opens the door for policy support, for strategic stockpiling, for incentives to develop domestic supply. Why does this matter? Because it confirms what market participants already know. Silver isn't just a shiny metal, it's strategic infrastructure. It's required for the energy transition, for technological advancement, for maintaining competitive advantage. And when governments start treating something as strategic, it changes the calculation around supply security. Will the US build a strategic silver reserve like it has for oil? Unlikely in the short term, but the designation creates a framework where that becomes possible. And it signals to industry that silver supply is a priority that could accelerate permitting for new mines, that could support investment in recycling technology, that could change the long-term supply curve. Let me give you some perspective on where silver stands relative to history. The all-time high hit on December 24th, 2025 at $72.70 per ounce is the nominal record. But adjusting for inflation, silver's real peak was in January 1980 when the Hunt brothers tried to corner the market. That peak, adjusted for inflation, is roughly $170 in today's dollars. So even at $72, silver is less than half its inflation-adjusted high. Gold, by contrast, has exceeded its inflation-adjusted 1980 peak. That's one argument bulls use for why silver has room to run. The catch-up trade. The idea that silver lags gold during the early phase of precious metals bull markets, then outperforms dramatically in the later stages. Is that happening now? Maybe. The gold to silver ratio declining from 85 to 1 down to 72 to 1 suggests early stage catch-up. If that ratio drops to 60 to 1 while gold holds above $4,000, silver would be at $66. If it drops to 40 to 1, silver is at 100. If it drops to the historic average of 15 to 1 during a full monetary crisis, silver's at $280. Now, do I think we're going to $280 silver? No, but that would require a complete breakdown of monetary confidence, a scenario where central banks lose control, where currencies collapse, where people flee to hard assets en masse. Possible? Yes. Probably? No. But understanding the range of outcomes matters, because it helps you size positions appropriately. If you think silver's going to 280, you should be all in, leveraged, aggressive. If you think silver's range bound between $50 and $80, you should have a position, but not bet the farm. If you think silver's heading back to $20, you should be out or short. Know your thesis. Size accordingly. And be willing to adjust when the data changes. Let me wrap this up by bringing it back to where we started. Christmas Day 2025, the UBS SDIC Silver Futures Fund crashes 10%, daily limit hit, trading halted. Investors who ignored 5 separate warnings just learned an expensive lesson about risk management. But here's the thing. This crash doesn't invalidate the silver bull market. It validates the need for discipline. It validates the warnings that fund managers were issuing. It validates the idea that even in strong bull markets, excess speculation gets punished. The investors who got hurt weren't holding physical silver. They weren't holding well-managed ETFs at fair value. They were chasing momentum in a fund trading at a 12% premium despite explicit warnings. The lesson isn't avoid silver. The lesson is avoid stupid. Don't chase premiums. Don't ignore warnings. Don't leverage yourself into positions you can't handle. Don't assume that because something went up yesterday, it has to go up tomorrow. These are basic principles that apply to every market, every asset, every time period. Silver is volatile, always has been, always will be. It's called the devil's metal for a reason. It can rise 50% in months and give back 30% in weeks. If you can't handle that volatility, if you're checking prices daily and panicking at every dip, silver probably isn't for you. Stick with less volatile assets. There's no shame in that. Know yourself, but if you understand the fundamentals, if you can handle volatility, if you're positioning for the long term rather than trading the short term, silver offers something compelling. Exposure to an asset with genuine supply constraints, growing industrial demand, and monetary hedge characteristics. An asset that can't be printed. an asset that's required for the energy transition, an asset that's historically preserved purchasing power through periods of monetary instability. The China crash doesn't change any of that. What it does is remind us that market psychology matters, that sentiment can override fundamentals temporarily, that corrections are healthy and necessary, and that when fund managers issue 5 warnings in 3 weeks telling you not to buy their fund, you should probably listen. So here's what I'm watching in early 2026. How silver handles the $60,000 to $65,000 zone on any pullback. Whether the premium collapse in China spreads to other markets. How industrial demand data develops as new economic reports come in. Whether central banks continue buying gold aggressively, which supports precious metals broadly. And whether retail enthusiasm remains elevated or takes a breather. My base case, silver consolidates between $55 and $70 for the first quarter of 2026. The market digests the massive gains from 2025. Weak hands get shaken out. Then we see where things stand. If fundamentals remain strong, if the deficit persists, if industrial demand keeps growing, the path of least resistance is probably higher, but the timing is uncertain, and corrections can last longer than expected. What I'm not doing? I'm not calling a top. I'm not saying the bull market is over. I'm not telling people to sell their physical silver. What I am saying is, be smart, be disciplined, don't chase, don't leverage excessively, don't ignore warnings, and understand that even in bull markets, there are corrections. And those corrections shake out people who don't have conviction in their thesis. The UBS SDIC fund crash is a warning shot, not about silver itself, but about speculation, about excess, about what happens when momentum becomes detached from value. Learn from it. Don't repeat the mistakes those investors made, because in 2026, there will be more opportunities in silver. The bull market isn't over, but it's not a straight line. And the investors who survive and thrive are the ones who manage risk, maintain discipline, and don't get caught holding overvalued positions when sentiment shifts. That's the real lesson from Christmas Day 2025. Not that silver is doomed, but even in the strongest bull markets, discipline matters. Risk management matters. And when someone issues 5 warnings telling you not to buy their fund at a 12% premium, you should listen. The silver story is far from over, but the speculative excess chapter just closed, dramatically, on Christmas morning, with a 10% daily limit crash that nobody who was paying attention should have been surprised by. The question now is whether you learned from watching it happen, or whether you'll be one of the people learning the hard way in the next cycle. The choice, as always, is yours.